What if I told you the rich are legally avoiding taxes you and I pay every single year? And not by cheating, but by using loopholes written right into the tax code. These aren't shady schemes or offshore accounts, they're IRS-approved strategies that you can use too. Today, I'm breaking down 5 hidden tax loopholes for 2025 that could save you thousands, or even millions, over a lifetime. Stick around, because the last one is so powerful that billionaires use it to wipe out entire tax bills. Welcome back to Money Moves, where we teach you how to learn, save, and stack. If you're serious about building wealth in 2025, make sure you hit that subscribe button. And let's dive right into loophole. Loophole 1, the Mega Backdoor Roth IRA. Most people know you can only put $7,000 in a Roth IRA in 2025, or $8,000 if you're over 50. But high earners discovered the Mega Backdoor Roth. Using a 401k plan that allows after-tax contributions, you can put away up to $69,000 a year. How it works: first, you max out the regular pre-tax 401k. Then you contribute more money after tax. The trick is, you immediately roll those after-tax contributions into a Roth. Boom, tax-free growth forever. Example: a 35-year-old high earner funnels $30,000 in after-tax contributions each year. After 20 years compounding at 7%, that's nearly $1.2 million tax-free. Why this matters: without this loophole, that same growth would have been taxed, potentially costing hundreds of thousands. Actionable tip: call HR and ask if your 401k allows after-tax contributions and in-service rollovers. If yes, you can do this today. Loophole 2, direct indexing plus tax loss harvesting. Everyone knows index funds like VOO or SPY. They're simple, low-cost, and tax-efficient. But the wealthy take it a step further: direct indexing. Instead of owning one ETF, you own the 500 individual stocks inside the S&P 500. Why? Tax loss harvesting at scale. If Apple drops 8% but the index is flat, you can sell Apple, realize the loss, deduct it against other gains or up to $3,000 of income, then buy Microsoft instead. Do this across dozens of stocks, and you can rack up thousands in tax write-offs every year, while your portfolio still performs like the S&P 500. In 2025, this is no longer just for millionaires. Fidelity, Schwab, and startups like Freck are offering direct indexing with minimums as low as $5,000. Example: if you invested $100,000 and harvested $10,000 in losses during a bad year, you could reduce your tax bill by $3,000 today, and carry forward $7,000 for future years. For the wealthy with millions invested, these deductions compound into six-figure tax savings over time. Loophole 3, the HSA Triple Tax Shelter. Health savings accounts are marketed as medical savings. But the wealthy see them as one of the only triple tax shelters in America. 1. Contributions lower your taxable income. 2. The growth inside is tax-free. 3. Withdrawals are tax-free for qualified medical expenses. Here's the kicker: after age 65, you can withdraw from your HSA for anything, like a traditional IRA, but without penalties. Hack: wealthy families pay out-of-pocket for medical expenses today, save the receipts, and let the HSA grow untouched. Later, they reimburse themselves tax-free, even decades later. Example: a 30-year-old maxes out their HSA at $4,300 per year. After 30 years compounding at 7%, they have around $400,000 tax-free waiting. That's before reimbursements. Extra perk: unlike flexible spending accounts, FSAs, HSAs roll over year to year. So you never lose unused funds. This loophole essentially creates a hidden retirement account the IRS barely advertises. Loophole 4, Qualified Small Business Stock, QSBS. Hidden in Section 1202 of the tax code is a gem: qualified small business stock. If you invest in a qualifying startup and hold the stock for at least 5 years, you can exclude up to $10 million in gains from federal taxes. Example, you invest $50,000 in a tech startup. 6 years later, your stake is worth $3 million. Normally, you'd owe capital gains tax, possibly over $700,000. But with QSBS, you pay $0. Why it matters? This is how early-stage investors and VCs quietly cash out with no taxes. Not just for Silicon Valley, many small U.S. businesses qualify, as long as they're C-Corp with under $50 million in assets at the time of issuance. In 2025, more angel platforms are letting everyday investors participate in early rounds, making QSBS slightly more accessible. Caveat: it's higher risk than other strategies. Startups fail, but the payoff can be massive. Loophole 5. Donor-advised funds, DAFs. The ultra-wealthy love donor-advised funds. Why? They combine philanthropy with tax strategy. Instead of donating cash, they donate appreciated stock. That way: 1. They avoid capital gains tax. 2. They get a charitable deduction in the current year. 3. They can decide years later which charities receive the money. Example, you bought Tesla stock for $20,000. Now it's worth $100,000. Donate it into a DAF. You avoid capital gains tax on the $80,000 profit and claim a $100,000 deduction this year. Bonus, you don't even need millions. Most brokerages let you open a DAF with as little as $5,000. Wealthy families often bunch several years of donations into one DAF contribution, turbocharging deductions in high-income years while spreading the giving out over time. These 5 loopholes are why wealthy families seem to get richer faster, not because they're smarter, but because they know how to use the rules. And here's the truth: the rules are available to you too. Which of these 5 loopholes would you use first? Drop a comment below. And don't forget, subscribe for more money moves every week, where we show you how to learn, save, and stack.